Okay, Anand, just hold that thought. We have Robert Pryor, Wondersford of Credit Suisse, joining in to talk about the rupee as well. Robert, hi, afternoon. Was this pretty much on expected lines, that 60 on the INR, and how much worse do you think it could possibly get for the INR now?
Yeah, I think it pretty much was along expected lines. I mean, certainly to give our FX strategists some credit, that's certainly what they were expecting. And they're looking for it to go, to 61.5 actually on a 3-month view, and 62 on a 12-month view. I just think, with the current account deficit as it is in India, clearly just to keep the rupee stable, India requires a lot of money every day, and it's not getting that money. It's as simple as that.
Yeah, clearly, I mean, with limited forex reserves, you don't know how much more the Reserve Bank can go ahead and, protect the rupee, Robert. But what do you think the Reserve Bank will do next? I mean, what could the steps look like, the more concrete administrative steps in order to stabilize the rupee now that it's breached this level?
Well, first of all, I'm often surprised, and this is no exception, by the lack of action from the RBI in terms of intervention. I mean, it clearly is very difficult to reverse the trend in this kind of market. But I think sometimes the RBI may be wise to step in at, for example, technically important levels, and to indicate to the market that they don't want it collapsing. They're not really sending that signal right now, and the market will continue to push it until the RBI is forced into action. In terms of interest rates, which I guess is really what's very important here, is the chances of any interest rate cuts now are zero. There's no way the RBI is going to be cutting interest rates for this kind of level of the exchange rate, and if this carries on at this rate for much longer, it may well be that we are talking at least about the possibility of rate hikes.
Well, that has been spoken about in terms of a credit policy reversal, and that's one of the things that the RBI also mentioned in their May policy, Robert, that if in case the current account deficit does not improve going forward or worsens going forward, then maybe there could be a swift policy reversal, is what they mentioned. But just coming to that point on the current account deficit in terms of a trend going forward, June is expected to be a better month as opposed to the $20 billion deficit that we saw in May. Hence, there is an expectation that maybe the current account deficit, or maybe the trade deficit rather, is improving going forward. Do you think that that maybe that is not the case then, that the trade deficit is not going to improve, and we might actually end up with a worse situation as opposed to FY13?
No, I think it will improve, but it is proving slow to improve. In particular, the rupee obviously has been weakening now for 18 months, 2 years, and we've really yet to see much, if anything, in the way of exports bounce, an improvement in exports on the back of this weaker currency. And that's, I guess, largely because global growth is still so incredibly soft. Now, the deficit, if I'm right, the deficit will narrow, but it's still going to be large. I mean, the current account deficit is still going to be in the order of $75 billion US, even under a very optimistic scenario for the current fiscal year. That requires, a lot of good news out of the Indian economy, to get the foreigners to finance that kind of level of deficit. The foreigners are not necessarily selling hugely at the moment. But just the very fact that they're not buying, it leaves that hole, and obviously leaves the rupee in an extremely precarious position. Until we start to get some better news out of globally, until we start to get some better news out of India, for example, in terms of some sort of cyclical growth recovery, for example, then India's gonna fail to get the funding that it requires.
So with this structural downtrend and structural depreciation that we're seeing in the rupee, Robert, how do you see the rating agencies react going ahead?
I mean, I think it's certainly the way they'll look at it is as a mild negative. Obviously, it increases the value of external debt, for example, in US dollar terms, and they won't particularly like that. At this stage, where I don't think, I'd be very surprised if it was enough to tip the balance for any of the three main rating agencies to swap India into sub-investment grade. But we could well see a move back to negative watch again. That I think is entirely possible. But this is not the only thing that matters clearly to the rating agencies. Improving the public finances, for example, is clearly a positive.
Okay, Robert, just one quick question before we let you go. There are some economists who have now started talking about a possibility that India might be going into a situation where it could face a balance of payment crisis, something that we saw many years ago. Is that something which is even being considered at this point in time by your economist group?
Not really, to be honest. I think that's scaremongering, to be honest, at this stage. Back in '91, India was down to, I think, 3 weeks of FX reserves. It has at the moment about 6 months of FX import coverage. It can cover about 6 months worth of imports. And external debt, even the short-term external debt, is comfortably covered by FX reserve levels. So this is in no way similar to the 1991 situation, but that doesn't mean it's insignificant. Clearly this is important, and clearly this could go quite a lot further.
So if you had to hear step 1, 2, 3 from the Reserve Bank or from the government in order to protect the rupee, what could it be? What would make the economists happy? Because we've seen many steps taken, like increasing in FDI limits, etc. But no one really believes that could really help in the medium term to solve the problem of the rupee. What are the key steps according to you that should be taken?
Well, it probably needs a fairly synchronized set of measures, both targeted at the short term and the longer term. Shorter term, some intervention, some further increasing in bond limits. After all, foreigners only own about 2% of the government, Indian government bond market. It is minute, and that could be increased significantly further. But at the end of the day, India faces a huge structural current account deficit. That structural current account deficit could be solved in the long term, by changing rules and regulations, allowing India to get more of its rich commodity base out of the ground, coal in particular, and also to encourage the development of a low-cost manufacturing export sector. Now, those are big things, require big changes, and unfortunately, I'm not holding my breath.
All right, Robert, we'll have to let you go on that note. Thanks so much for giving us your view. So that's Credit Suisse. They say that this was par for the course, and they won't be surprised to see even 62 to the dollar very soon. But let's get in.